and welcome you tuned into Midcap Masala right here on ET Now, a show where we tell you what's all is happening within the midcap space and also get you the management voices. And firstly, let me welcome the management of Aurionpro on the show. We are being joined by Mr. Ashish Rai, who's the Vice Chairman and CEO of Aurionpro, joining us on the show. Hi Ashish, good morning and good to be speaking with you. And first up, Ashish, let's talk about your numbers then. And the numbers look quite good at this point in time. Help us understand what transpired, because your revenue has seen a good jump of almost 45%, but there has been a pressure on your revenue and your EBIT margins as well. Help us understand what were the factors behind it.
So first of all, morning and thanks for having me. I would not sort of characterize it as good. I mean, by our own standards, I would say if I was to characterize the overall year, I would say it was below average. I think, we've been growing reasonably strongly, 30% plus for the last 4 years. So growing at 20% for the full year, I would say is muted. The way I would split this first half of the year, fairly strong on expected lines. Second half of the year, I would say muted with some unexpected developments. That's how I would sort of characterize the year. And mainly in Q4, the banking side especially, but the business overall, we bet quite heavily on Middle East as a growth driver for the business. And the war has had some effect, both in terms of deal conversions, where you've seen slowdown in decisions. It's not that the deals have gone away, but what we were expecting to convert in Q4 did not convert. And we've also had some issues in terms of putting people on the ground to deliver projects, right? So that slowed down further. So one was the Middle East, and the second is the data center side. I think we picked up an extremely large deal, and there's a slight mismatch between the need to make an investment in Q4 versus when the execution starts, which got delayed into Q1, right? Other than that, I would say the growth trajectory for the business remains strong. We've had very large deal wins on the transit side, very large deal wins on the data center side. We're rolling out a brand new banking AI stack. So the medium-term trajectory remains intact. For the full year, I would rate myself and how we did below average, but I think that those are temporary factors.
Ashish, thanks for being so candid on the show. Really appreciate the way you've put together your quarter four and the year gone by. This is Snehi also joining in the conversation. You did say that there were certain deals that you were trying to convert in quarter four that have now got pushed. On the back of this and the kind of base that we've seen in quarter four, do you reckon FY27 will be a better year for you than FY26? And how has quarter one already begun to shape up for you?
Yeah, so thanks, Nate. Great question. So like I said, right, I think the medium-term growth trajectory, we feel very positive about, right? So we feel transit, we built out one of the most competitive stacks in the world. We're winning really large deals like the 250 crore, MMRDA order that we announced earlier in the year last year. Data center, we become one of the prominent players in the space. Extremely strong relationships getting built up with the leading hyperscaler. So that business will continue to propel ahead. Banking and AI, we believe we have a very specific point of view on where the banks need to go. And increasingly, we are at the center of it. We are rolling out a brand new stack. We launched a trade finance application a few weeks back now, which is the first fully native trade finance application, and we'll launch a whole series of applications from here, right? So feel very good about where the growth drivers in the business are and how we are executing against it. I would hesitate to really say anything concrete about where this year is. I feel we are well positioned, but there's obviously, it would be unfair to throw out a number out there given all the uncertainty, both the Middle East war, as well as a lot of other factors that we don't really control around supply chain disruptions, even on the data center side and all, right? So I would say optimistic on where the growth trajectory is, but I would hesitate to throw a number given, I don't think it's fair to throw a number given the uncertainty that we all know about.
All right. But Ashish, help us understand that what sort of a capex are you planning for FY27, and especially with respect to the data center opportunity? How are you placing yourself?
Yeah, so data center for us is largely a services business where we are increasingly trying to move towards the product side, introduce our IP. but we will not get into any sort of a heavy capital deployment on that business. We will largely very capital light on that business. We work with hyperscalers. We run one of the top design shops in the country. We run one of the top implementation shops, but we won't put our own capital on the business, with the exception that we are pouring money into R&D to try and build products out into the space and move across the spectrum, right? So we'll increasingly be a larger player, but we'll be fairly capital light on that space. On the investments overall, this is the moment for us to really step up the investments, as we've been clear about the last couple of quarters. We feel we are ahead in terms of AI capabilities that especially the banking space needs, but overall the enterprise space needs. We have a very specific point of view on what the next generation of banking software should look like. And this is the time for us to really move with speed and build out. So we are undertaking a massive build program around the whole banking stack. And you'll see some of that in the last quarter, but also in the quarters to come. We'll continue to invest around data center products. We'll continue to invest around the hardware side as well. So we are a full atoms to bits player, right? So we work on the software stack, but we also work on the hardware stack on transits. We'll continue to invest there in terms of building out the hardware and systems capabilities as well, right? So plan fairly significant investments across each of those three areas for the next year.
So that sounds optimistic on the capex front and how much you're looking to pour into the business. But Ashish, also talk to us about what this is going to do to your margins going ahead. Now, this quarter, of course, because of the reasons you've mentioned, margins have slipped slightly. But by when should we look at margins returning to your historic 20 to 22% levels, or at least if you can give us any visibility on when we can once again cross the 20% threshold?
So for the actually, for the full year, we are still at 20% plus, barely, but 20.02 or something. So broadly, if you look at the year, right, EBITDA is, we said, between 20 and 21. It is between 20 and 21, towards the lower end, of course. PAT, we said between 15 and 16. It is at 15.02 again, or something like that. So at the lower end, but pretty much within the band. I feel as we move ahead, the main factor is the stepped up level of investments that we need to make right now to meet the moment we are in, which is very significant. You almost cannot sort of underemphasize the transformation that the banking stack especially is going through, but transit and data center spaces as well. So we have to step up investments to meet the moment. But overall, in terms of the margin trajectory, I think we've hovered around pretty much the same levels. I feel like we will try our best to sort of keep up at it. But even if there is some dips, those are temporary factors. Longer run, we feel very confident that each of our businesses is on a strong margin trajectory, and that should sort of overall improve as the operating leverage comes in and the scale comes in.
Right. And Ashish, on that note, lastly, what would that do to your book-to-bill ratio? Any number that you can share with us where it's right now versus where you are aiming for it to be?
Yeah, so look, we don't necessarily track it's a very, at least in my head, a very services-oriented metric, and we are fundamentally a product organization, so we don't really track it very actively. I feel what is really happening to the business overall is the scale of transactions that we are doing has increased, right? So if you, every year that gets stepped up. So, I mean, last year, if you look at it, we probably announced 4 or 5 different deals, which are north of 100 crores. If you go back the year before, there was only one deal, which is north of 100 crore, right? So I think the scale of transactions is going up. So if anything, the book-to-bill ratio will sort of go in the opposite direction, will actually get worse, purely because you're booking much larger transactions. On the banking side, I would say the transaction sizes are still smaller, but on transit and data center space, it will only get bigger, right? What we feel is, if you look at order book as a whole, if the order book stands at, let's say, something in the range of 1,800 odd crores, almost 70% should be executable over the next 4 quarters. I think that's how I would sort of characterize it if you're looking for that metric.
All right, and we look forward to that. But Ashish, with this, we let you go. So good having you on the channel today. Thank you so much for your time.
Thank you.
All right, so that was the management of Aurionpro talking to us that what did not go well in the quarter gone by, but what can go well in the times ahead is something that he focused on. But with this, it's time now to slip into a very short break. Don't go anywhere. We'll be right back on the other side.